Ew, that's not really going to tell me. So annoying. Is that how this works? Oh, here it is. There you go. So now we look at the SPY. Still no video? Making me sad. Sad, sad, sad. Wait, what is this? Finance.yahoo.com. SPY. I'm going to pretend you guys can see this even though nobody's confirmed it. SPY. Fine, into save SPY. No, thank you. And historical data. There you go. All right, thank you. Still only Corey. It's gonna be one of those days. So Corey, personal consultation day today. Anything you want to talk about? Let's see. We got look, the volume is often sucky. I mean, this is still all a holiday period, but 60 million, lots of 60s, 70, 60, 60, 70, right? So today we're at 31. Yesterday we did 51 all day. So we're below the low end of what's even been coming in. And by the way, volume used to be 100 million a day. These are SPY shares traded. That's like the best proxy for what's going on because people are constantly trading the SPY ETF back and forth. And so it gives you an idea what the total market volume is. And the bottom line is like, back in the day, 120 million was a normal day. Now it's considered a busy day. And we're at 60, 70 million. So it's almost half of the volume we used to have. And that's weird. And what that means, especially, is the less volume there is on the ETF. That means the more computers are trading in the background compared to humans. And that means that the market's the good thing for us is the market tends to follow the 5% rule very closely. It is a rule that takes into account computer trading's effect on the markets. And so the less human trading there is, the more accurate the 5% rule becomes. But it's a very thinly traded market that can change very fast when they're like this. But it means any move you see is just meaningless. It goes down 200, up 300, down 200, whatever. It doesn't mean anything. It's just silly. And where are we now? 379. We were at 379. La 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 la. Here you go. We were at 379 on November 7th. We were at 379 on October 24th. We were at 379 back on September 20th. And no. Oh, and here you go. And July. Yeah, so we're going like nowhere all year long. We end up, this has been the basic levels that we've been following. And of course we have our SPX chart. This only goes back from July where we just looked. But here's where we are now. So we're just under 3,800 here. And we had an up period and a down period and an up period, and now we're back in the middle. There's nothing happening. If you look at the bigger picture, there's really nothing going on. Look at a longer term chart. Oh, come on. It used to fill in the dollar sign for you. Now you got to do it yourself. I don't understand why they make things worse. So basically, at the end of 2020, this is kind of where we finished in 2020. So nothing has really happened for so we have 2 years and we're in the same place. So after 2 years of this bullshit rally, we're all the way back down to where we started back in 2020. We don't know what's going on next. My big concern, which we just talked about in the chat room, if I can find it, here it is. We'll talk about that after. I believe in Bob Christmas. Let's see. The big news. Oh, here's the big news. But this is exactly what we expected would happen, right? So in Italy was the first place in Europe that got really hard hit by the virus. They got very, very hard hit. So they've been testing more people than most of Europe as far as like incoming flights and people at airports and cruise line terminals and such. So Milan reports 50% of the passengers on Chinese flights have COVID when they test them. So China is basically packing up planes full of infected people and shooting them across the planet. And that's only because they're testing them in Milan. That doesn't mean that's not happening. It's not specifically to Milan. That's just where they happen to be testing them. Whereas in Los Angeles, they don't test. So, that's how it is in America. We don't check at all. Most countries aren't even checking anymore. And why is that? Because testing costs money. It costs money to test everybody who goes off a plane. So people want to shut that down as fast as they can. But the danger is you're letting in all these people who have COVID to reinfect everybody who's here. And God forbid, they develop a strain that's not that doesn't respond to the vaccines we've been getting, and we're back to scratch almost on COVID. So, look, that is the main wild card we have to deal with. And of course, we knew this was going to happen. So every time everybody celebrates, like, oh, China's reopening, it's like, that's, there's going to be a backlash. And this is a very big backlash. It's in the country. And this is what happened to poor Tesla, because they shut down everything in the country again. Not even voluntarily. People just aren't coming to work. The people are freaking out. And you'd be freaking out too if half the people caught COVID in a month. It's essentially, imagine if half the people in your town had COVID. So in other words, everywhere you go, everyone you talk to, they all know this guy they all talk about, oh, who got COVID today? This guy got COVID today. That one got COVID today. This guy, he's got COVID. That store's closed. They all have COVID. Blah, blah, blah. That's the whole freaking conversation again. The same one we were having back when it started spreading, except this is rampant. This is like the worst possible case scenario. They took a country with no resistance to COVID and told them to all start mingling again. They didn't even phase it in. That's insane. But anyway, so that was one major wild card we were concerned about. We're concerned about the global recession, and this is not obviously going to help. We're concerned about inflation, and as I said, there were two possibilities. Either China would reopen and the demand from China would cause inflation, right? If they reopen successfully, their additional demand would cause inflation to spike up again, or they would have a COVID issue and they're going to have to do stimulus again, and that's going to cause inflation. So either way, we have more inflation ahead. We still have that. We still have the war. The war continues. We have our little housing meltdown that continued today, where what was it? Was it housing starts, or what kind of housing was it? There was some bad housing number. La la la. No, not that one. Where is it? I just reported on it. Is it way down here? No, that's the Milan thing. We had the Richmond, pending home sales, right. So pending home sales were down 4%. And this is like down and down and down month after month after month. These charts are important, actually. It's a shame when they don't come out. The Richmond Fed was flat, like no improvement. It was actually pretty sad. And you can see here, oh, this is State Street. State Street investor confidence came out today, and this, to me, this is a crazy. I don't know why you would make a note like this. Confidence among North American investors showed a slight improvement. Did it? Did it? Here's North American investors' slight improvement. Is that even worth mentioning? Like, this is catastrophically bad. This is an investor confidence index going back to 2002, and in the 2008 financial crisis, it was at 80, and it's now at 65. Again, after the market collapsed in 2008, we were at 80, and now we're at 65. Okay, that's the confidence of investors. All right, and the other one was something similar but not the same. Oh, I see. This is compared to the S&P. So for some insane reason, here's investor confidence once again with the tiny uptick that we've got here. So here's the investor confidence, and here is the S&P, as if this doesn't matter at all. All right. So anyway, I'm not going to defend it every time. It's just that's why we are cashy and cautious. That's why we've got much less positions in our portfolios. The future is now, fell to 36%. That's terrible. Oh, I got to update the 700 a month portfolio. I forgot about that one. Oh, still up 6%. Very nice. Long-term portfolio. 437 is a step back for sure, but it's still big money. So $2.7 million in that portfolio. And it's got 2.4 million in cash. You know, we took everything off the table except for positions that we think are super bulletproof. Who knows if we're right, but this is what we're left with. We'll see. But meanwhile, we can certainly adjust our way out of problems. And the short-term portfolio is up 1 billion% or whatever that is, and that's 3.7. So 2.7 and 3.7 is a big number, right? So 2.7 plus 3.7 is 6.4. So we have $6.4 million that we were. We began taking cash outs when it was at 5. So we're still making money. We still make, you know, we've made a tremendous amount of money since it was at $5 million. $5 million. $4 million was our goal. So we're 50% over our goal. There's nothing to worry about here. We lose that 400,000, I'll be upset, but it's kind of hard to lose it when we're so well protected, you know. You know, when we went through this last time we did a review, we're incredibly well protected with these. And again, 3.7 million in, talked about this in the last portfolio review. $3.7 million is the total portfolio value, but 3.6 is cash. And we only have $90,000 net of hedges. And we don't have a lot of downside risk. It's not like we have this tremendous, our main risk seems to be the open calls that we sold. We sold short calls, but we haven't sold puts to a great extent. You know, 20 UNG puts, that's nothing. Call. This is a put spread, so that's not a risk there. There's no margin risk there. Coin, we have 20 short coins, and call. So we have, you know, and again, I mean, 20 short coins is $100,000 worth of coin, but it's nothing compared to the portfolio. So we technically have no real risk to the downside, and our only risk is that we have more short calls than we do long calls, but those short calls are very out of the money, so we don't consider them risky. Margin requirement wise, there's a risk considered, but realistically, we seriously do not believe that SQQ is going to go to 90. That's just inconceivable that this is going to become a problem for us. The same thing goes for the TZAs. We really don't think TZA is going to go up 100% to 70. It's just not where we don't expect it. And even if it does happen, we have $3.6 million to spend on rolls. So we're not really worried about this stuff at all. So these are phenomenal hedges because we have, I believe it was $5 million worth of hedges that we spent $90,000 net on. And there's not a lot of risk to the downside for us. You know, there's no, we're not going to get slammed if the market goes higher and these all fall to pieces. We can only really lose this $90,000. We don't have a lot of put risk. So these are phenomenal hedges, and that's why we're willing to keep those long, because we are so well protected that it really doesn't matter to us if the market falls. We're going to catch back a lot of money. And those positions are all positions we don't mind putting more money into. On the other hand, and we did the math in the last review also, the long-term positions are going to make so much money if the market goes up that we won't give two craps about losing $90,000 in the short-term portfolio. So this is a, you know, exquisitely well-designed, if I do say so myself, an exquisitely well-designed paired portfolio in the long-term and short-term portfolio. We're just so freaking hedged, and you can do those hedges now. There's nothing magical about them. They're available still, and we're so well hedged. And then we don't have anything we consider extremely risky in the long-term portfolio. They're all things that we don't mind putting more money into, and the puts are mostly new. You know, here's 11, 9, 12. Oh, I'm sorry. Yeah, it's 22. I'm sorry. 11, 12, 12, 11, 9, 9, 10. So all but 3 of these are very, very new. That's just a dividend payer. We don't care. There's 43 spreads. BABA, we really would like to stick with. We want to keep playing BABA because we think that they'll settle this China thing and it'll suddenly shoot back up. Best Buy, I did not like the numbers in Best Buy. When we review this next time, I might cut it. I did not like the what I've been hearing from Christmas shopping does not bode well for Best Buy. Big Lots, we were just talking about them, and I think they're going to be a long time to turn around, so I'm not sure we want to wait. Chimera, I would put more money into until they come back, even if it takes 10 years. Comcast, I don't see as being a problem. Coinbase, I want to keep putting money into. I think their lack of collapse. And meanwhile, look at these puts are killing us, right? We sold some puts. The fact that they're still alive when everything else is collapsing around them, I think they're gonna do very, very well after the dust settles here. Crocs is an easy money kind of thing. Dell, again, it's like computers are having a hard time, but I'd stick with Dell. Gold is gold. Google is Google. Hanes is underwear. Hewlett Packard is Hewlett Packard. Intel is Intel. JD's another Chinese turnaround. JP Morgan, we like it enough to buy it twice. Jackson Hewitt, nice little financial company. Levi's is Levi. Lockheed Martin is Lockheed Martin. Lowe's, nothing wrong with Lowe's. You know, if it's either them or Home Depot, you want to have them in your portfolio. Medtronic, of course. MetLife is a easy money insurance company. Facebook, obviously, been beaten down like crazy, and I'm sticking with them. I think this metaverse can actually work out. Philip Morris, people are going to smoke. Netflix, people are going to binge. Paramount, disappointing, but long-term, I like it. Pfizer is Pfizer. Rig is based on oil prices staying high enough to bring people back to deep ocean drilling. Signet with the diamonds, I think is good. Shearing Plow, not Shearing Plow. Simon Property is a mall operator. I think, again, one I'd keep putting money into forever. STLA is Fiat Chrysler, basically. I like them long term. SWK should stick with. SYF, yeah, I don't see why not. AT&T is AT&T. TD Bank. Target, yep, Target's good to stick with. Tenet Health, they'll work it out. People are still going to get sick and go to hospitals. Trox is specialty. When the economy turns around, they'll do great. Walgreens, I always love, even though they don't always love us. Wheaton Precious Metals, again, I think inflation-wise and hedge-wise, it's great. Williams Sonoma, again, rich people are going to cook. Weyerhaeuser is that's a more of a forestry bet. And then Yeti is our stock of the year and doing terribly. What is this? Oh, those are old. Those are old calls. Oh, those are the short calls. This is kind of wacky, huh? We're getting killed on the short calls, but we're not making money on the long calls. So we're getting ripped off on the volatility, basically. It doesn't matter though. What we care about is, are we in the money? We're not even in the money, so it doesn't matter. But we can't, you can't lose $22,000 on our short calls if our long calls are not in the money, right? So we're going to roll these and take advantage of the fact that they're low, that they're still low. We have these $50 puts for 2024. Might roll those too. But yeah, this is just being, when you see something like this, you're like, well, I'm just being ripped off by the spread. That's not fair. I mean, these obviously have some ridiculous premium, and they do, because Yeti's at 40, and the $50 calls are 10 bucks. But the $35 calls are 12 bucks. So these guys are $15 lower and only selling for $2 more. So what do? You take advantage of that. Let's find a way to take advantage of that. That is an outrageous price for the $50 short calls. Let's figure out how we can sell lots more of those. So we'll see if we can be clever about it when we do the review. But that's an interesting thing. That, by the way, it's an important thing in the portfolio reviews. Like when I'm going over the positions, we just looked at all the long-term portfolio positions. When we look at the positions, when you see something that's not fair, and that my little one, Jackie, my daughter Jackie's, that was her thing when she was a kid. That's not fair. She used to always scream. If something wasn't fair, she would freak out. And this is not fair, right? When you see something that's not fair, don't scream. As I tell Jackie, like, don't scream about it. It's like, let's figure out how to take advantage of what's not fair. It's not fair, but nothing prevents you from taking the not fair bet, right? We took a neutral bet. We said we think it'll be between 25 and 35 and 50, and we paid $50,000 for a $150,000 spread. And at the moment, the net of that spread is $30,000. So we're on the losing side. But why are we on the losing side? We're on the losing side because it's $22,000 loss. We're showing a premium, right? Here it is right here. It's $2.20, right? That's $22,000. This $22,000 loss. And so what happened is this one went up, the short calls went up, and the long calls went down. That's not fair. We lost on both sides of our spread. But in that case, there must be something we can take advantage of. If something's not fair, say, how do I get the part that's not fair on my side? So what we'd want to look at is to say, we should sell more short calls then somehow. Let's figure out how to do that. And how do you do that? Well, we could sell twice as many of these and then roll this into like a huge spread in 2025 and take advantage of this sale. Like, let's take a look. So if we look at Yeti, because those are 2024. So if we go to 2025 and we took like the 40s are, let's say, $13.50, and the 55s are $8, let's say. So that's going to be $5.50, right? Yeah. So it's what I just say, it was $14.50. 1435s, or wait, no. The 40s, 1350, sorry, 1350 minus, we said the 55s were going to be $8 is $5.50. Yeah, minus 8 is $5.50, and yet we're selling. We're going to sell these $35 calls for $12.10. So we have $121,000, right? So we have $121,000 worth of calls. We divide that by 550, That means we can buy 220. So we could buy 200 of the 40, 55 spreads, but the stock's at 40. Now, what if we bought the 30, 45 spreads? The 30s are 150, 75, 18, let's say 1825. 1825 minus the 45s are, let's say 1150, 1150. So that spread is 675. So instead of buying the 40, 55 spread, we could buy the 35. Wait, did I say the 30? I did. We can instead buy the 30, 45 spread instead of the 40, 55 spread, or maybe we could buy the 35, whatever spread, the 35, 50 spread, something like that. But we could spend $6 or $7 instead of spending $5.50 and have a lower spread that's already deeply in the money. And then we've already sold, like I said, we have sold the 2024 50s, right? That's what we've already sold. And they are, well, they're $6 here. What did they say over there? What did they say in the portfolio? Oh, these are 2025 50s. Ha ha ha. We already sold the 2025 50s. We have the 2024 longs. All right, well, that changes that a little bit then. But anyway, we could roll these back to 2024 so they expire sooner. But then we have to roll them to more. I'm sorry, I thought that was the same year. So we have $96,000 worth of short calls. So, and again, this is this is all the hassle I go through when I try to work out these entries in the portfolio to try to figure out exactly what we should do. So if we have 90,000 of those, we know we can do 200 of these spreads, whichever one we decide to do. And then we have to sell $90,000 worth of short calls. And we've got 200 longs. And if we sell 150 of these at $6 of the short 50s, that's good. But I would be too worried that we're going to go over that number, though. That's the problem. I think I'm a little too worried about that. If we look at April, ew, the 50s are $1.60. I wouldn't want to sell those. No, we're going to have to wait and see what happens. So, and that's why we're getting ripped off, by the way. These are expiring. The premium here is expiring faster than the premium here, and that's why we're not making money on these longs. So we're going to have to fix a couple of things to make this spread work. That's going to be some homework. I'm going to have to figure all that out. See if you have any questions. Do you like Apple today, says Corey. Boy, it's a Corey show. There's nobody else talking. I know it's a holiday weekend, but where is Apple? Ooh, ow, look at that ugly chart. Ooh. Oh, and that's a long-term chart too. Ooh, it's like bam, 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 bam. I don't think from that perspective I'd want to jump on it and be the rescuer. It's not like you're going to save Apple by just buying it yourself. We need some kind of catalyst. I mean, I like Apple down here for sure, but the thing is, what is the market going to do? That's what we need to be more concerned about. Again, I don't want to be like doom and gloomy, but you got to take this seriously, this China thing. They've got 1.5 billion people. They're going to have 500 million cases of COVID if they keep this up with the reopening. They're going to have, every country in the world has about 30% of their population has gotten COVID. China has not gotten COVID. But that's because they haven't let anybody out of the house for like 3 years. Now they're saying, okay, go on out. You're all fine now. They're not fine. They're not immune. There's nothing better about the Chinese people that they're not going to get the same COVID everybody else got. You know, we are all human beings. We have a 1/100th of 1% variation in our genes that accounts for all of the differences you see. You know, we are basically all identical people, and we are all susceptible to identical things for the most part. There's not too many custom viruses that only affect one kind of one people from one part of the world or the other. There are a few. There are things that certain people are susceptible to. But anyway, point being, it ain't COVID. So that's, you know, this is a serious thing. We don't know how badly this is going to impact stuff. And the real danger isn't even the 500 million Chinese people that are going to get COVID. We already had 1 billion plus people in the world, 2 billion people in the world got COVID. They're just lagging behind, so they're catching up. That's fine. The danger is, though, that when a large segment of your population has COVID, it tends to mutate, and if it mutates into something that nobody's been resistant to in the rest of the world, then then we go right back to the whole same bullshit again, and we have another goddamn year lost to COVID. And the government's already broke from bailing us out of the last one. So, you know, you can't overstate that risk, and I know it might not happen, but you can't play assuming it's not going to, you know, you can't just assume something's not going to happen and keep going. You can, and you might luck out, and you might do really well, but if you're wrong, you're totally screwed. It's not worth the risk. Some things are not worth the risk. It's not worth, you know, you can drive 120 miles an hour in the rain on the highway, and you will probably hydroplane, but you might not. So a prudent driver doesn't do it, okay? You can do it. You can get away with it. You can look like Mario Andretti, but that doesn't mean it was a good risk. And that's the thing also, I don't see the reward here. I don't see this gigantic reward of the market blasting higher. I think we need to just grind out gains. This is a year for being careful. This isn't, certainly right now, this is an environment for being careful. So we have heavily hedged, and we have a group of positions that are generally really good stocks that we're very happy about, but we're going to have to always constantly reevaluate those. We started our watch list, which started, I started doing the stocks today. So, you know, here's the list as it remains. These are all the stocks that are still on, that are on the watch list. And what I'm doing is doing the charts, because the idea is these charts over the course of the year, we can refresh this, and the charts I think, and I hope, if otherwise I'm going to be pissed off, these charts should refresh. They used to in the old system. I assume they do in this system, and if they don't, I'm going to be annoyed as hell. But so I'm just putting basic notes on them, and I'm trying to be consistent so we can evaluate them consistently and say, look, 15x, 15x. So we know when we look at it 6 months from now that 136 was 15x and now it's at 110. Ooh, isn't that exciting? Or is it exciting? Or is it much worse than we thought? So I'm thinking cloud services are growing state, insurance companies are good, the specialty gases, you know, and that's the thing Air Products doesn't have. They only have one major competitor in the world. So they're just like a super necessary thing. And it's always silly when they sell off, frankly, because there's no reason for it. You know, Apollo Management is crazy cheap. So so what we look for is at any given time, we say, well, who's low in the channel? Who's cheaper than when we came in? So 6 months from now or 3 months from now, every time we look and we say, oh, it's not about looking at these stocks in particular. What it's about is the timing of the market and saying, oh, those earnings, like after Q1, we might say, oh, those earnings weren't so bad, and China's COVID thing is receding, and the Fed seems happy that inflation isn't doing so bad, so now's a good time to look at stocks. Then we go back here and we flip through these and we say, who's low in the channel? And to do that, though, I need to say where we were at the time, because we lose track of that. I know this from experience. Like, where were we when we made these picks? So here, BNTX 160, they're down $4, now they're down another $5. All right, but I said, but then what was my note on them? my note was it's 9-time earnings, but it's a lot of that is COVID vaccine money that's winding down. So if China's COVID turns out not to be bad and the market is down, that doesn't mean this is a good company. Because I'm like, oh, well, we're turning around because COVID's not so bad. Therefore, this may not be the stock we want to jump on for that turnaround. We get Berkshire. We got BXMT, which is a Blackstone mortgage thing. I think this is stupidly underpriced, and it's only at 7.7 times earnings. I mean, you know, what people are saying here is that, okay, it's a mortgage REIT run by Blackstone, and what the hell do they know? And they're like the world's biggest asset management company. They know a lot. They understand how to manage this. It's not like they're going to be totally baffled by rising interest rates. Boyd Casinos, and again, the COVID issue has got to be keeping them down. Citibank, this is weirdly cheap, right? 7 times earnings for Citibank seems very odd. Cheesecake Factory, I never understand why people don't respect them. That's too cheap. Caterpillar, not cheap at all, but if it comes down to here, I'll be excited. Capital One, also getting no respect, another bank, and these guys are trading at not even 6 times earnings. Isn't that crazy? Capital One Financial. It's a serious bank. It's a very modern, innovative bank too. Chimera, again, another REIT that's getting absolutely no respect. But you know, this is where we always buy them. This is where we bought them 10 years ago. And I said the same thing. I'm like, what is wrong with people? These guys know how to run money. This is what they do for a living. You're not gonna knock them off their socks because the rates changed. And last time it was because rates were rising. Was it rates were rising? No, rates were going down. I'm sorry. No, last financial crisis, rates were coming down rapidly and everybody was selling off CIM. Now the rates are going up and everybody's selling off CIM. So in other words, people are just never happy. Meanwhile, the company is fine. They make money. They made money then. They make money now. They're going to keep making money. You know, so those are the notes against these companies. And I've got to go through, Jesus. I think we knocked off like one line so far. So it's going to be another 1, 2, 3, 4 days worth of work for me to get to it. Hopefully by the end of the weekend, I'll have the proper thing done. It doesn't matter though. It's just stuff we're going to refer to for the rest of the year. That's what we do. We set up a watch list, and we have stocks that we watch, and every once in a while, we might add something to it. But generally, these are the stocks that we're going to be excited about when they get cheap during the year. And every time we do reviews, we're going to be looking at portfolios, saying, what does this portfolio need? That's the other thing. You know, you go through the portfolio, a little hard on the long-term portfolio, but let's say we're going through the dividend portfolio. Well, now we don't have any stocks. So going through a dividend portfolio, we've got Simon Property. We like them if they get cheaper. We sold the puts. We have Gilead. We like them if they get cheaper. We sold the puts, but these are going to expire worthless now. AT&T, Dow Chemical, Jackson Financial, Philip Morris, and Vitaris. Those are our dividend payers. We don't have Energy Transfer because they got expensive, so they're on our watch list. You know, and then we go back to the watch list. So where to go? So who pays dividends? Oh, here. So that's way back to BXM, BNTX. No, wait, not BNTX, BXMT. So BXMT, who pay, not there. Yahoo, there's another Yahoo, wasn't there? Chart, nope. I don't go to Yahoos. There, haha. So yeah, so Blackstone Mortgage pays 11%. All right, so doesn't that make sense? So we would put it in the dividend portfolio because we don't have much in the dividend portfolio. We'd like to add another stock. BXMT is only 21.80. That's a good price. We can certainly work that in there. So, and then we would double check it. We go BXMT. And we say 3.8 billion. They're making 400 million, $500 million. Check. They've got a lot of debt, but that's because they're a mortgage REIT, and that's how mortgage REITs work. And you have to understand that. And 24 million here, and we check their projections. We take a look at their, we go back to like here and see what they have, BXMT, see if they have a plan they've shared with anybody. They're paying their dividends. They had an earnings call presentation. Yay. We love presentations. Click to enlarge. And what do you have to say for yourselves? Floating rate portfolio, 100% floating rate portfolio. So what does that mean? That means 100% of their loans are set at floating rates, which means that as rates go up, the money paid by their borrowers goes up. Now, presumably, they're clever enough that they've borrowed money at fixed rates, so they've got low rate money that they're paying out, and they're collecting high rate returns. That's a huge positive. It's not a negative when rates are going up for them. Driving significant year-over-year earnings growth. Okay, so well-positioned performance with earnings benefiting from higher rates, liquidity, stable performance, diversified, well-structured balance sheet, earnings power, fully scaled $26 billion portfolio, positively correlated to rising risk. Could you even understand why anybody would be getting out of the stock? It doesn't even make sense. Senior lending positions further insulated by strong sponsors, match funded long duration liquidity structure. And by the way, this isn't a sales brochure. This is their investor report. They're not allowed to lie here. I mean, people do. They lie, they exaggerate, they cover things up. But, you know, realistically, these are probably pretty accurate statements. Match funded long duration liquidity structure with subsequent liquidity. These are good numbers. Third quarter results, 3Q GAAP earnings, 60 cents, 62 retention portfolio. 26 billion secured by institutional quality real estate with a weighted average LTV of 64%. Strong performance, 100% interest collections, rate caps and other structural protections, 96% of the portfolio. In rising, so they've got rate caps on their other stuff, on their borrowings. Collateral assets positioned NOI growth, inflationary higher environment. 3Q originations of 438 million with top sponsors focused on collection on highest conviction themes, 78 backed by assets. New loans reflect attractive lending environment. 58% LTV. So the LTV is you know in good shape. All good there. Look, see earnings per share. Look at this. They're not being hurt by higher rates. It's idiotic to sell these guys off because of higher rates. 26 billion, 205 loans secured by institutional assets with growth-oriented business plans. And notice it's only 205 loans. So look at their collateral diversification. Mostly they lend on office space, multifamily, and hospitals, hospitality, hotels. And mostly it's in the Sun Belt, which is a great place to be lending. Second is the Northeast and the West. Not much in the middle of the country, not much in foreign. Well, UK is a good chunk. Here's Eastern Europe, where they're having a war. Then they're still collecting the money, it doesn't matter. Activity, highlights, this is all good. Diversified, stable balance sheet, and that's it. And then you can look at the numbers. But these guys are in fantastic shape. So yeah, absolutely, you should add these guys to the dividend portfolio. And by the way, that's what a watch list is for, right? You go through your watch list, you look at who's low in the channel, and you say, well, why? Is there a reason we shouldn't be adding these guys? No, not at all. So then the next part is I want to look for a trade that I can make on them. So I say BXMT, and we see if they're a good candidate for option selling, and they are. They go out to 2025. We could buy the stock for 22. We can sell the $20 calls for $3 or more. And we could sell the $20 puts. I like that. We can sell the $20 puts for $4. So if we got $3 for the calls and $4 for that, that's 22 minus 4 is 15, right? 22 minus 7. So 22 minus 7 is 15. So we would net in for $15. We have a call away at $20, which is a 33% profit if we're called away. Meanwhile, we're going to collect an 11% dividend while we wait. So that's 11 for all of this year coming up, right? So 11%, another 11% is 22%, plus 33% coming back is 55% in 2 years if we get called away at 20 and the stock is at 22 right now. So this stock would have to fall 10% for us not to make 55%. That's a built-in cushion. And that's what hedging is, okay? That's a built-in hedge. We have a 10% hedge built into the price of the stock in the first place. Now, if it does fall and we get assigned another batch at 20, that means our average is going to be the net 15 plus 20 divided by 2 is 1750. 1750 from 2177, well, it's 1750 divided by 21.77 is 80%. So it's 20% below the current price. So that's our built-in cushion. This can fall 20% below the current price, and that's where our break-even point is. Oh, not including the dividends, not including 22% of dividends. So we really have a 40% cushion, providing the dividends keep up. The main reason the stock would fall more than 20% is because they would cut the dividends, right? So we could get double whammied on that. But meanwhile, if they pay the dividends, we have a 60%, we have a 40% cushion. Without the dividends, we have a 20% cushion on the stock price alone. So as long as we're willing to double down, that means the stock could fall 40%, right? So that would be 2178 times 0.6. So the stock could fall to 13, almost 50%. Now, if the stock's at 13, we have the stock at 1750. But if we could then still sell $5 worth of puts and calls, we wouldn't have to, right? We wouldn't have to put in any extra money. We would just drop our basis from 1750 down to $13. And then we'd be break even on anything 13 and higher and still collecting the dividends. So if the stock is at 13 and we're collecting 10% dividends, we're fine with that too. And then the worst case would be we would end up with 4 times shares at 13, then we're buying at 21. But as long as we set ourselves up for that and plan on it, we're going to be fine. So this is like almost a no-brainer, right? Because unless you can envision them going bankrupt in short order, we're going to be able to roll our way and expand our way into almost anything they can throw at us. They could drop 50% and we'll be fine. And as long as they keep paying those dividends, we're always going to make money. So, right now, let's say we're willing to buy 1,000 shares. It's $21,700, right? And then we sell, so then we sell the, these are 4, what do we say, 7. So then we sell $7,000 of puts and calls, is 14.7, right? Then if we collect $1,100 twice, so that's minus $2,200. His 12.5, so our basis becomes $12,500. If we're called away at 20, we make money. If we get assigned, if the stock is down and we get assigned 1,000 more shares at 20 where we sold the puts, so that'd be plus 20,000. Now we spend $32,500 total. We've collected from what we've collected back, etc. And here we are in 2025 with 2,000 shares at 32.5, so obviously $16,250 or $16.25 per share. And then if we could still sell puts and calls, that drive us $4 lower even, right? We're selling 7 now, so let's say we can only sell $4 worth of puts and calls. That still brings us down from $16 a share to $12 a share. So unless we're down at $12 a share, we're going to be making money. And not only that, though, if we're taking, don't forget there's 2,000 shares here. So if we're taking $8,000 off, minus 8, 1, 2, 3, okay, that's $12 a share. So we have 2,000 shares. We have the short puts, and we only spent $24,000. We were going to spend $22,000 right now, but here we have 2,000 shares instead of 1,000 shares. That would be our 2025 position. If it drops from there, from 12 down to 6, and we do it again, then we're going to spend 12,000 more plus 12,000 more for 2,000 more shares. If we still collected the dividend, we wouldn't give a damn about any of this stuff because the dividend would have been another $4,000. But let's say forget the dividend. That's our total. We divide that by 4,000, and we're at $9 a share with 4,000 shares. And if we then could take that in 2027, if we then take that and knock $3 off it, we're going to be down to $6 a share. Now, if we're not paying the dividends, we're probably not going to bother. But the point is, the stock can go down and down and down and down, and we're still going to be in decent shape if they keep paying their dividends. If they stop paying their dividends, we're still not terribly hurt. And that means there's basically no reason on earth not to buy it right now, right? We already have a plan for the future, and that future only takes us to $36,000 from $22,000. So if we set aside $50,000 now, we're never going to be upset about this. In fact, we're going to be kind of pissed off if we just make the money and get called away at $20,000 with a nice profit, with a 55% profit. So we get called away at $20,000 with a 55% profit from the dividends and the interest in 2 years. We're going to be disappointed. That's all we made because we were ready to spend $50,000 and do a lot better. But all we ever needed was to put in the it wouldn't even be putting in $20,000. We'd be putting in $15,000, but we're setting aside a $15,000 allocation block. So we're only starting with 1/3 of our allocation block, and even if it goes down by half, and then it goes down by half again, we're still not going to be all the way into our allocation block. But that's the point. You want to have a plan that says, I'm going to accumulate this stock over time. And if you don't get to accumulate the stock over time, that's because it went up fast and you made all your money that you planned on. That's not a terrible thing. So yeah, this is like a no-brainer for the dividend portfolio right now. Citibank obviously is going to fit in a portfolio somewhere. Cheesecake Factory is going to fit in a portfolio somewhere. It's just a question of looking through them and seeing whether, what portfolios they're going to fit in. Where do we need a food stock? Where do we need a mortgage REIT? Here's another one, obviously, CIM that we would put in. Then we've got Cleveland. Then we've got Cliffs, Comcast, Delta Airlines, Disney. I'd be worried with the COVID. See, I'm worried with the COVID there. Dick's Sporting Goods, if they're cheap, I want them. Dow we have it in portfolios, I think, still. If the economy's really turning around, maybe FedEx, maybe UPS. I don't think UPS is on here. UHS, but not UPS. There's Ford. You know, you just got to look for who's a good dividend payer that I want to add to the dividend portfolio. So you just look through this list and say, who pays me dividends? That's what I want to put in. You know, AT&T, nice dividend payer, but it's already in the dividend portfolio. Yep. Oh, and there's Dow. See, we got a place for everything. WY pays a nice dividend, don't they? Let me see. Nope, only 2.2. All right, but CIM, $14.8% dividend. How's that? 14.8%. That's just nuts. And notice they didn't reduce it. They just had earnings and they didn't say nothing about it. They said, yeah, we're gonna keep paying this dividend. That's insane. And you want to see, I mean, why would you, and again, it goes back to the same thing. Why would we not do this? Okay, so here's CIM. It's a $6 stock, but you can sell the $5 puts for $1.30, $1.25, $1.30. So let's say we sell them for $1.25. That nets us into the second set for $3.75. All right, so if we have $5.95 for the stock minus $1.25 for the puts, and then we're going to sell some calls, and let's sell the $5 calls for $1.40. So minus $1.40 for the calls is $3.30. And don't forget, we're getting called away at 5 with a $1.70 profit. That's more than 50% profit if we get called away. So you say, well, why don't you sell the $7 calls for 70 cents? You could do that, but why should I? I'd rather buy more stock like this when it's net $3.30. So it's net $3.30. They pay a 90-cent dividend. So I'm getting a 33% dividend basically at net $3.30. Plus I get called away at $5 with a 33% profit. So here we're going to make, we're going to make 33% per year against $3.30. So we're going to make 66% and 33% when we're called away at 5. We're going to make 100% profit on $3.30 if we get called away at $5, which is lower than it is now. And then if we get assigned, if it's below $5 and we get assigned, our net is only $8.30, which is going to be $4.15 a share, which is significantly lower than it is now, which is almost a third lower than it is now. So our worst case scenario is owning the stock for a third off of what it is now. So again, we set up an allocation block, and the allocation block would be the same $50,000 that we had before. And in this case, we'd want to spend about $15,000. We'll spend about a third of it. And so spending, although given the extent of the discount, we may want to do it a little bit differently. But we'll spend about, let's say we spend a third of it. And we would then have, I'm sorry, a third of it's 15,000. So we could buy 50. So we would go 5,000 shares. So we buy 5,000 shares for $30,000, and then we take the numbers off and whatever, and we do this times 5. Whoop, wow. What was it, 330? I don't know what that was. 330 times 5,000, 16.5. So we'd be in for $16,500 or whatever. Or whatever the number is. I don't know how it works out. But whatever the number works out to. So we're in for about $15,000 on the thing. If we have to double down, we'll be in for $30,000, but it'll be less than 30 because when we double down, we're doubling down for a lower amount. And if we're in for less than 30 and our allocation block is 50, that means we could double down again, no problem. Means the stock can be at freaking $2 and we'll have 20,000 shares. So what? I mean, you can have 20,000 shares for $2. We'll have 20,000 shares for whatever it is we take off, plus less whatever dividends we collect, and so on and so forth. But could you imagine having 30,000 shares that you pay net $2 for, and they're still paying a $1 dividend, 50% a year, and that's what you collect? I mean, obviously, if you took all your freaking money and you put it into something that paid you 50% a year dividends, you're done. Hopefully, I mean, I assume, but you're done. You don't have to retire. You don't have to work. You don't have to think about money again for the rest of your life. So you got one freaking stock that pays you a 50% dividend. You know, life isn't that easy, but it's, you know, I mean, this is the way it would be that easy. You take some of your money and put it into this stock. And if things go well, you'll put more into this stock over time, or buy similar stocks like it. Like we have NLY, we have CIN, we have AGNC. There's a few of these REITs that pay super amounts of money. Even the one we were just looking at, though, the Blackstone one, even that one pays a really nice dividend. And it doesn't look so nice after you look at this one, but it's still really nice. And that's what a dividend portfolio is for. So this, unlike last time, we have a good profit in the dividend portfolio because it's been running since 2019, but we now have $400,000, so we can put $100,000 into these high-risk dividend stocks. We were not able to do that before. We didn't have the ability to risk it, but now we're up 200%. We can take 100,000 and put it into these, and if we can engineer them down over time to pay us 50% of our 100,000 in dividends on an annual basis, we'll never have this whole portfolio will be gold, and we'll never have to worry about it again. You know, this is what you got to learn how to do, and it's not. But again, I'm talking years. I'm talking about this year, we're doing this and we're knocking it down to here. And in 2 years, we'll make 55%, but we're not going to take 55% off the table. We're going to re-up our position and sell more puts and more calls and so on and so forth, you know, and we do that until we have no cost basis left. And then if we have no cost basis left and we're still collecting 33% a year against the original cost basis, that's 100% profit, and we're using the money that we collected to buy new stuff and increase it. But this is over 2 years and 2 years and 2 years. These are 6-year cycles generally that we do these things for. But you can see how powerful it becomes because look how much money we're making on this freaking thing now. This is only, I mean, 2019 was, this October 2019 was only 3 years ago. And we're up 200%. This is a very conservative portfolio. And we're all cash, not all cash, we're 80, 75% cash, something like that. You know, so you don't need to have a lot of money in play to do this stuff. But it's very, very, very powerful. So did we really answer Apple? Did I say we? I mean, oh, I know. I remember what I said about Apple. I said I love Apple, of course, but I don't want to catch a falling knife on them. You know, we have to see what iPhone sales are like. You want to make an informed decision before jumping in. That's what I think. You know, and momentum-wise, you really, you know, I mean, since the beginning of the year, down and down and down, you're going to be catching a knife. So let it fall and let it show you where it's bottoming. And certainly I'd wait to, you know, it sucks to wait, but I'd wait for earnings and see what happens. Why are the bid-ask spreads so wide? Al is asking. I'm not sure which one you were talking about, but the bid-ask spreads are, it depends on the stock. If a more commonly traded stock like CIN is going to have really wide spreads. The more a stock is traded, like Apple, should not have very wide spreads because it's heavily, heavily traded. Now, of course, when you go out to 2025, though, these are the least traded options. But so Apple's still pretty far. See, it's like, but if you're into the zone where it's traded, well, this is not 27.60, 28. That's not wide, right? 25, 25.85, 23, 23.50. So you can see those are fairly normally tight. But if you do Yeti, which is not as popular of a stock to be traded, and you go out to 2025, you got 13, see what you got here? You got on the money, you got 13.40, 15, 13, 13.70, 11.40, 12.80. So, you know, you got a much wider spread than you're going to have for Apple. That's what it depends on. It depends on if enough people are betting to set up a proper market for it. But, you know, look, don't ever let that throw you off. You pay what you want to pay. And that's what I do. When I set it, I always, now, I default to picking something in the middle if I don't know better. You know, I'm going to look at something and say, I'm going to say this is like 11.40, 12.80, so therefore it's $1.40 spread. Therefore, 70 cents more than this is 12.10. So if I'm not sure, I'm going to say 12.10 makes sense. You see this, the last time it was actually traded was 17.50. It was miles away from here. This hasn't been traded since it was 17.50. So there's no market for this right now. On the other hand, this one just went for 12.25. That's what you do also, is you got to look around and see which ones did trade recently. But again, if I think that, so for Apple, let's say, all right, if I want to set up an Apple 100, 130 spread, so Apple, the 100s are at 30.65. Actually, there's only a 15-cent spread there. So Apple's at 30.65. The 130s are at 7.50, also very tight spread. So these are clearly being heavily traded, and they're 7.50 and 30.50. So that's going to be $23. And I'm not going to pay $23 for it. And see, that's out now, because now I'm not going to pay $23 for a $30 spread. Why am I doing that? There's no fun in that. So now I'm going to say, well, how much is a 110, 140 spread? The 110s are $22.50. The 140s, I'm trying to do a $30 spread. The 140s are $5.50. So that's $17 for a $30 spread. That's actually not so bad. $17 for a 30 spread, and we're in the money. That's actually not a bad deal. 120, 150. The 120s are $15.50. The 150s are only $3. So that's, you know, $12, or a little bit more than $12. No, a little bit less than $12. Sorry. So that's going to be about $12. Let's call it either way. So it's either I can spend $17 for the 110, 130 spread, 140. 110, 140 is $17, or the 120, 150 is $12. Well, that's a lot of difference. So it's actually, you know, $17 or $12 makes a big deal, right? So I would go, since I firmly believe Apple is worth way more than it is now, I'm comfortable with the 120, 150 spread. So that's now my baseline, is I'm going to pay $12 for the 120, 150 spread. Now, since I'm bullish on Apple, I'm going to offer $12 here and just wait and see if it gets filled. And I'm not even going to want to sell these unless Apple fails to hold 120. So I'm going to say, look, here's what I'll do. I'm going to offer a lower price. I'm going to offer, where did I say $12 for the one? Oh, it's the 125s. So I'm sorry. So for the 120s, which say 15, I'm going to, which say 15.50, I'm going to offer $15 for these, and I'm going to see if they fill. If they don't fill, let's pick a totally different spread. But I'll offer $15 even for these, and hopefully Apple spikes down a little bit lower, and I get 15. Then I'm going to say to myself, okay, here's what I'm going to do. I'm going to fill these first. I'm going to hope that we bounce back. If we go below 120, or let's say below 125 even, I might start selling a few of the short calls. And if I can't sell, remember my goal was to get in at 12. So if I fill these at 15, I only need to sell something for $3. So I go to the 150s. I wanted to sell them for $3. All right, so I'm going to try, but if Apple's dropping, then maybe I'll sell the 145s for $3, and I'll still be in for 12, but not as good of a spread. Or if it just keeps dropping, maybe I'm then going to roll my 120s to the 110s, which are currently $22. That'd be idiotic to spend $10 to roll down $10. That makes no sense. No, I keep doing that. The 120s. I'm sorry. These are 15. And no, it's not that much. It's 7. Still wouldn't spend it though. So these are 7. But if I could roll down for $5 and then sell, then I'm in this one for 15 plus 5 is 20. Then I just figure out what I can sell for 5. So if I could then sell the 135s for 20, I'm sorry, the 135s for better than 5, I'm back to a $15 spread. except that I'm down to the 100s and the 125. So I'd be happy with that. So the point being, though, if I'm bullish, be bullish, right? If I want to be bullish on Apple, be bullish, but I'm going to ask first for the cheapest possible price I can get for the spread that I want the most. I'm going to buy the leg that I think I can fill. And since Apple is in the middle of falling, I think I might be able to fill these 1550 puts for 15 bucks. So I'm going to give it a shot. If I don't get it, I'll readjust. Now, why wouldn't I get it? If it goes down, I'm going to get it, right? So if it goes up, I won't get it. That means these guys, these 120, these 130s, well, I'm not doing the 130s, I'm sorry. So the 120s. So if I take the 125s, which are 12 now, if these didn't get filled, that means these are getting more expensive, right? But it also means these are getting more expensive if they're going up. So the only way I wouldn't get filled here is because Apple is going up. And if Apple's going up, then I should probably buy these for maybe $13.50 and then wait for that momentum and hopefully sell the 155s and hopefully get $3 for them instead of $2. And then I'm back in at $10.50 for net. So you have to decide which direction you think the stock is going and make your play accordingly, make your entries accordingly. Don't just buy spreads. That doesn't make any sense. You have to use your head and say, do I think the stock is going up or down? Because if you think it's going up and you buy and you get yourself a good price on the first entry and you get your price a good price on the second entry, you can do way better. It does matter. It matters a lot, especially when you realize that you're paying, you're looking at a spread you were going to pay $12 for and you get it for 10 instead. You've improved your position by 20%. You always want to try to do that. Now, I know she's saying, if you have time, please talk about how to start a butterfly spread and adjustments if prices go against you. It's the same thing. It's exactly what I am talking about. The idea of a butterfly, and again, you sell the parts, you know what you need to do, right? You want to set up a spread. So a butterfly spread is usually that we're going to be selling, we're going to be taking a long position like I'm just talking about here. We're going to sell some puts. So when do I want to sell the puts? Well, I sure as hell want to sell the puts when the stock is going down. So when I think I found a good bottom, that's when I'm going to sell my puts. Now, I would look at Apple. And again, we need more information. I said that before about Apple. I need more information before I commit too much money to Apple. But as far as a starter position, I know pretty well that I'm comfortable with $120. In fact, that was our premise last year, was we really felt 120 would hold. So I know I don't mind paying 120 for Apple. Now, there's two ways I can look at that. I can either sell the 120 puts for $7, and I would consider this to be a free $7 because I have no problem buying Apple for 120. Or I could sell the 130 puts for $11 because I still net 120, except now I don't consider this money to be free. It's the package I signed up for. But if that's going to be my first play with Apple, is to sell these puts while they're still expensive, I'll do that. Now that I've collected so much money here, though, I can be patient and wait to make sure we're forming a good bottom here, because I've already collected $11. But either way, I'm going to do this and build my spread. So let's say for now I want to be cautious. And again, it's very relative, because when I say cautious, I'll sell 5 Apple puts for $11. It's $5,500, right? If I sell 10, it's 1,000. That's 11,000. Yes, $5,500. So if I sell 5 for $5,500, I'm obligating myself to buy 500 shares of Apple at $130, right? So my allocation in that case is now 500 times 130 is $65,000. So I've obligated myself to spend $65,000 buying Apple. So you shouldn't be, unless you don't consider this a big deal, unless this is no more than 10% or 5% of your portfolio, shouldn't be doing it in the first place. You're making a very real thing here of saying I'm going to buy $65,000 worth of Apple stock. But if you do that, now you're being given $11,000. All right, so I've got $11,000 now because I promised to buy the Apple stock. I'm sorry, not $11,000, $5,500. So I got $5,500, and I promised to buy 500 shares of Apple here for this, right? Now, I can now take that 5,500 and put it towards a spread. And so if my spread is the 110s for 22.50 and the 140s, well, no, in the butterfly portfolio, see, it's different in the butterfly. I don't need to be that low because my goal is going to be to sell longer term calls, right? Short term calls. So I just need to be at the money. I don't want to be too deep in the money. Why should I spend it? So I would take the 125s for 12.50 and I would sell the 155s for 2. But like I said, 2 is a bit cheap, right? So let's say I just buy the 125s for 12,500. So now I'm going to spend 12,500. All right, minus 5,500 for the puts is $7,000. And what am I doing? I'm going to wait and see how much I can collect selling selling the 150s, let's say. I said the 125s, right? So we can go, so we're selling the 120, we're buying the 125s. We're going to sell the 150s, but I'd like to get $4 for the 150s. Because if I can get 4,000 for the 150s and I only spend 3,000 net on the whole spread, right? That's fantastic. And also, what am I going to sell? I'm going to sell March. March seems good. Okay, so that gives us 3 months. And I'm going to sell the March. We're at 126. Let's say the 140s for $4 or 390. So how many of those am I going to sell? Only a couple, because I'm very worried. I'd be too worried Apple's going to go up. But I can sell 3 and collect $1,000 or 11 something. So don't forget what we're saying is we're saying we're going to enter into the spread. We're intending to knock the spread cost down to $3,000, right? That's when we finally sell those short calls. We're going to have a spread cost of $3,000. Meanwhile, I'm going to collect, just selling 3 of the 140 calls, I'm going to collect $1,200 basically. And if I do that using 79 days, I'm going to get 8 chances to do that. So I'm going to have 8 chances to collect $1,200. That's $9,600 against my $3,000 spread. But plus, it's a 125, 155 spread. So if the spread works out, I'm going to collect $30,000 more dollars. So I can end up collecting $38,000, $39,000, $40,000 in this spread against my $3,000 initial investment. Now I've got the obligation to buy the Apple stock for $65,000. Don't ever forget that. But even so, over the course of 2 years, if I get $30,000 or $40,000 back against a $65,000 a margin requirement, even if it's a portfolio, even if it's an IRA or something like that, and you have to put the whole $65,000 down, it's still a good return. If you have a margin account, though, you're using very little margin to do something like that. Here, I'll show you. What do we say we're going to do? The 130 puts? No, that sounds high. It is what I said. Why are these $20? Somebody tell me why I'm confused. I said we pay 120. Were we not looking at the 2025s? Were you looking at the 2024s? I don't know what the hell we were looking at, but it wasn't the right ones. Look how much more money that is. Well, that's all different math, but it's the same concept. It doesn't matter because it's whatever stock it is and whatever thing you're doing. Well, shit. I mean, if you can sell the 120 puts for $17, I do consider that free money, and that would be $8,500 for selling 5. So you have $8,500, and if I sell these puts, the 130 puts, no, the 120 puts. Sorry, the 120 puts. We're going to sell them. And we're going to sell 5 of them, plus. So we're going to sell 5 of those for, I'm going to sell them for, I'm going to add 17. And we confirm that. And we get $8,500. And the buying power effect, it only takes $3,500 off your buying power in a portfolio margin account. See that? So you're only using $3,500 of buying power. You're still committing. Don't forget though, you're still committing to buying $60,000 worth of Apple on the 120 puts, but you're collecting $8,500 and only using $3,500 in buying power. That's fantastic. That's what you call margin efficiency. Then you look at the 125s, which are 28 in this case, and the 155s, which are 17. So yeah, I don't even worry about what it is. So it's 11. So you're spending $11,000 on 10 spreads, right? Let's make sure we got that right. It's the 125s are, whoop, now they're 30. Are these changing that fast or am I screwing something up? The 125s are 30. The 155s is 17. So it's $13,000. So it's $13,000 minus $8,500, 8,500. Wow, really? 13,000 minus 8,500 is 4,500 for the net. All right, and you've got a $30 spread here, the 125, 155s. You can only, so your short put, the short calls you sell are only going to hurt you if you're getting more and more in the money. But we're going to plan on selling these other puts. So we have a net $4,500 commitment here. We're using $3,500 in margin. And we sell the March, once again, the March 140s, and there they are for $4. See, they told you they come up. So we sell the March 140s for $4, and this is 4,500. Let's remember that. So we sell these for 12. We sell 3 of these for $1,200. All right, and we do that 8 times. It's $9,600 against our $4,500 outlay spread. Now that we sold the 120 puts, so the only way we really lose money is if we sink below 120, and then we've got to buy the Apple stock. But as long as we don't mind buying 500 shares of Apple for 120, there's effectively no downside for us. We're happy to buy 500 shares of Apple for 120. But to the upside, we're only selling 3 short calls. We'll be able to roll them because by the time we get hurt by the short calls, we're going to be $30,000 in the money on our long spread. So worst comes to worst, we just buy another long spread for another $4,500 net dollars. We already made the money on the first long spread, right? So we can double up on our long spreads. And if that goes in the money, we'll double up again. Because I don't really mind if I have 50 of those long spreads if they keep making me $30,000 every time I roll them over. And we just keep rolling our short calls along until we end up having to ultimately pay them off. As long as Apple doesn't jump up to $200, we're going to be fine. And what's the chance of Apple going to $200? Very slim, because Apple All right. How are we doing, guys? Are we connected? Can you hear me? Hello, hello. Anybody out there? Lost your audio. Screen seems frozen. So is it unfreezing or is it? Can you hear me now? Is the question. And I'm probably talking to a blank wall. Yes, you can hear me now. Can you see the screen now? You're back. Screen's good? How is the screen? Can you see? Is the video back? Nobody's going to tell me if the video's back, huh? Everybody's saying I can hear you. Okay, maybe there's a delay. Somebody says yes. Yes does not help. Another person says yes. Video good. Thank you, Corey. See, Corey is the man. Corey was the guy earlier who was in there and telling me that things were cool. All right, thank you, Corey. Yeah, okay. I don't know how long that was out, but we'll just wing it from here. Anyhow, so there you go. That is the most comprehensive explanation you will ever get on how to set up butterfly spreads. Thank you. Oh my God. Anyway, so whatever. Let's see. This stuff. So nope. Full start there. All fell apart. Nothing we're surprised about. Oil is popping up. RB, natural gas, very nice. Should be making some money there. Trade, active trader. Wow. That's why I love natural gas. It's so much fun to play. That's just stupid money. Okay, you know what? I'm gonna take. Oh, you bastard! The minute I try to take it. Come on. There we go. Let's lock in some cash. Oh, it's flipping all over the place. All right, so now we got 2 longs left, and we're in good shape. So basically, even if I stop out at 450 now, I'm still gonna have some nice money because the basis is 439. But hopefully, it's just pausing here for a move higher. This whole thing was silly. I mean, there's no good reason for this sell-off. All right, so that's where we are on that. So where were we? Back to all right. We talked about the watch list. We talked about what's on it, and that's how we're going to be using it. Okay, so in other words, you're just going to be able to go to it anytime. You're going to be able to hit refresh, and we'll see who's down and who's up. And of course, I care about who's down, who's cheap. You know, we just have to be aware of when we started it. We started it at the beginning of the year. That'll make it easy, right? So we started at the beginning of the year, and did we improve from then or not? And if the ones that didn't improve, you want to say, well, is there a good reason for that, or is it just stupidly priced? You know, like take Capital One. It was stupidly priced, and now it's more stupidly priced. And eventually it becomes irresistibly stupid. CIM, irresistibly stupid at $5. Other people agree with me at $5. It was overpriced. Then it was fairly priced at $10, which we had no interest in. And then it became cheap, and now it's getting not as cheap, but that's fine. This is a decent price to be starting off a position. That's the use of the watch list. I already know we want the stock. If nothing has changed in the next, 6 months from now, if nothing has changed, but the stock is cheaper, we're probably going to want them more than we want them now. That's what a watch list is for. You should always be working off a watch list. And just like the butterfly thing we were just talking about, you want to start by saying, okay, what do I definitely want to do about CIM? So here's my dividend portfolio. Here's CIM. I'd love to have a position in it, but for now, I'm going to just pay attention to it in the dividend portfolio. So I'm going to sell these $5 puts for $1.50. Right? Somebody just paid $1.55. So I'm going to sell these things for $1.50. And I'm going to sell 10 or 20. Let's say we sell 20. So we buy 2,000 shares. So we're obligating ourselves to spend $10,000 for 2,000 shares. We're going to collect $3,000 right now. We're going to collect $3,000 in exchange for promising to buy the stock for $5 when it's currently $5.85. So I promise to buy CIM from you for $5, which is almost 20% below the current price. So I promised to do that, and you're going to pay me $3,000 to make that promise. That seems like it's all working out for me, right? Not only that, though, but you got to consider the dividend is 90 cents, right? So it's almost 2 years dividends. I'm getting paid 2 years dividends not to own the stock. So there's just no reason not to do that in the dividend portfolio, right? Why would I not do that? I want to collect $3,000. I would like to buy CIM if it gets cheaper. There's no reason for me not to make this transaction. And my worst case would be owning 2,000 shares of CIM for a net of $5 minus $1.50, which is $3.50. Net $3.50 is 40% below the current price. My worst case scenario is getting 2,000 shares for 40% below the current price. I do not foresee anything that horrible happening to them. And if it does, I don't really care, because I will buy another 2,000 shares when they get to $2, unless there is some catastrophically major problem with them that I'm unaware of. And if that's the case, then I will pull the plug and say no thank you. And if that's the case, I will then lose $5,000, $6,000 on the transaction. Oh no, so my net, I'm sorry, no, because my net is $3.50. So if my net is $3.50 and it's at $2 and I decide not to buy it, I'm going to lose $3,000. So my risk is $3,000, but I'm collecting $3,000 up front. And if the stock goes to 2 and I decide I don't want it, then I'm going to walk away with a $3,000 loss. I'm going to have to give this $3,000 back, and I lose another $3,000. I lose $3,000 in total. That's my worst case. My best case, the stock goes above and I keep the $3,000 and never end up owning it. That's that. Or I also add a bull call spread and make a lot of money on the way up, or I buy the stock and make a lot of money on the way up. So there's lots of ways I can win. There's only one way I can lose, and that's if the stock drops 50% and is and it looks so bad that I didn't even want to play it anymore. So unless I'm completely wrong about the stock or they totally fall apart, it's a perfectly good idea to sell the puts right now, right? There's no reason not to. And then that's the graduation. Something graduates from the watch list to go into your short put pile, right? Then it becomes, because then then you're watching it in your portfolio actively. So in the long-term portfolio, for example, well, even in the dividend portfolio, we have gold. And what do we do with gold? We sold the 5750 puts. I'm sorry, not gold, Gilead. We sold the 5750 puts last year, not last year, 2020, in 2020. We sold the 5750 puts. So in 2020, I said, you know what? If Gilead is at 5750, I'll buy 500 shares. And this guy says, you know what? I will pay you $10.75 per share, or $5,300, for promising to buy my Gilead for 5750. Now, where was Gilead at the time? $2 years. So here you go. So in October, September, oh, see why I did it? You can see why I did it, right? It fell. Gilead was falling down low. So I took my watch list and I said, ooh, which one of our stocks is low in the channel? Well, I guess Gilead was, right? Because this is exactly when we sold it. So when Gilead hit 60, here you go, 1019, right? So the next day after Gilead hit 60, we said, you know what? I promised to buy Gilead at, oops. So that's when we jumped in on 23rd anyway. So when Gilead was down around 60, we said, I promised to buy it for 5750. When? 1023. I sold the 2000. I sold it in 2020. I sold the 2023 5750 puts for January. So basically it was almost 2021 then. So it's pretty much a 2-year put. So I said 2 years from now, I promised to buy this stock for the price. It was almost around 5750 then. So I'm telling a nervous guy, I'm going to buy it for 5750. He's like, thank you. Here's $5,000 for making that promise. So that guy sold me the puts, hoping to guarantee the stock wouldn't go any lower. That probably gave him the courage to hold on to it. Meanwhile, though, it never really went lower. We didn't get it, it didn't go lower. It stayed above that line. We made a good call at time for the bottom, and now we've made our money, and now it's going to expire worthless. But it's on our watch list. So the whole time for 2 years, we've been keeping an eye on Gilead in that portfolio. See, and it went lower again. It went below 60 again, but it didn't affect us because it wasn't lower enough to matter. And then it went flying up, and we never really got a chance to add to it or do anything to it. It only recently went down to 60s. But the bottom line is we were watching it and we were able to, and had we decided, had we been paying attention or decided that we needed to get something during this year when it was down still around 60, we could have added, and had we added, it would have been great, but we didn't. No big deal though. We picked up $5,000 for doing nothing. And here's Simon Property, which we just added. And it's the same thing, Simon Property Group. And you guys know I've been going crazy on Simon Property Group. It was a runner-up for stock of the year. Runner-up to the point where we did add it to the money to our portfolio because it was too good to ignore. So here's Simon Property Group, and before Thanksgiving, when I was reviewing stock of the year ones, this is when we went crazy, and I said, this is nuts. I mean, it's below $100. It's insane for this company. And here we are again, and this is, by the way, also a good dividend payer. What do they pay? 6%. See, really nice. So they pay a 6% dividend. And so on October 11th, we sold, again, I'm promising, I said, you know what? We'll buy it for 90. 90 is my floor. So we're at 90. I said we'll buy it for 90. We got paid $18. That's why I was loving it. It's really the amount of money they were paying on these freaking short puts, and it was crazy. The premiums on these are just outrageous. $18, that's 20%. So we're at 90. We're getting another 20% discount from the guy. The guy's saying, here you go. Here's 20% for just promising to buy the stock for 90. We're like, I'll take that. We net into the stock for $70. I would be thrilled to get it for $70. Oh, it's never going to happen, but we would be thrilled to get it for $70. And if it goes to 70, we're going to roll it anyway. We're not even going to pay 70. If we get it signed, we're going to sell calls. We're still not going to pay 70. I mean, that's the beauty of being an options trader. We have that power. So here we collected $18,000. We promised to buy 1,000 shares of Simon Property. And all we do is watch it now. And if this turns red, here, well, AT&T's not red for that. If the put turns red, we don't freak out. We go, oh, look how cheap Simon Property went. Maybe we should add a bull call spread to that. Because we know we want it. And if nothing bad happened to the stock and it's just out of favor, then we want to add and build a better spread to it while it's cheap. When the puts turn red, it means it's a good time to set up a cheap bull call spread, right? You've got to learn to get into that mindset. But the point is, we start with the watch list. These are stocks we would be interested in having. When we see them down here, we then check and say, okay, why is it down here? And did our premise change since our original? So in other words, I say originally, I had written back in I wrote back in January of this year, early in the year. I said, people have no faith. 620 is this much, and 6.2 times earnings. They don't even lose money in 2020. I would then go back and check my premise. But at least I remember it's enough to remind me, why did I like these guys? What was I thinking when I put this thing on my watch list? Then I go back and I see, oh my God, look, it was $6, now it's $4. I say, are they $4 because something bad happened, or are they $4 because people are idiots? And if they're $4 because people are idiots, I then just double check and make sure there's nothing I'm missing in the numbers. And if I'm not missing anything in the numbers, I go, oh, what a great time to buy. It's even cheaper than it was when I said I liked it. And that discipline on the watch list is how we made so much money in the last couple of years. Every time the market would go down, we go back to the watch list and say, who's cheap? Who on our watch list is now buyable? And what we're not doing is we're not buying whatever Jim Cramer screams about in the evening. We're not buying what some analyst said. We're not buying something we read in Barron's this week. We're buying things that we have decided over the course of 2022. In the last few months of 2022, we put together 100 stocks we like. Of those stocks, we are watching them for 2023. And not because they're faddish, not because they suddenly make a headline, and not because of this or that. They're because we found values here. They're all ones we found values in, and they become good candidates for the future. And we reevaluate, we look at their earnings, we gather more information, and if they're still holding up in quarter one and quarter two and quarter three, whichever ones happen to be cheap, and at any given time, I guarantee you 10 of them are cheap. There was never going to be a time when 10 out of 100 of these things are not cheap. That means anytime we have a hole in our portfolio, anytime we have some extra money to spend, anytime we're feeling bullish about the market, we just go back to our watch list and say, who didn't we buy yet? Who is sitting on the sidelines waiting to be added into our portfolio that we've already evaluated, we've already looked at them, we already know we like them, but now the price is good too. That's it. You know, it's like when you go to the grocery store and something's on sale. Like you didn't plan on buying it, right? But you like it. Like, let's say mac and cheese. I don't buy mac and cheese regularly, but if you tell me it's freaking 3 for $5 or something like that, I'll buy mac and cheese because I know somebody's going to eat it one day. And it's 3 for $5, so I'm going to buy it because it's on sale. The fact that it's on sale doesn't make me say I don't like mac and cheese because it's only 3 for $5. I don't like that anymore. I used to like it when it was $2.50 a box, but now it's 3 for $5. I don't want to buy it. That makes no sense. But that's what you do with stocks, right? Nothing changed except the price, and people go, "Oh, I don't want that anymore. It's terrible." That's why TA is the devil, because it makes people think that way. You're still looking at a chart and letting the chart tell you what something is worth. If I look at the mac and cheese chart and it used to be $2.50 a box and now it's 3 for $5, that chart's going to look pretty ugly, right? I'm going to see this chart for macaroni and cheese dropping from an average of $2.50 a box to an average of I can't do the math, $1.75 a box. So it went from $2.50 to $1.75. Something must be wrong with it, right? Something must be wrong. That's what you do when you look at a stock, right? There must be something wrong with it, so I should stay away. It looks ugly. Look at those candles. Look at the way it forms. Look at it's all bullshit. And not only that, you'd see rising volume, right, on the mac and cheese because it got cheaper and the volume went up. You say, oh boy, heavy selling volume. It's not selling volume. It got cheaper. Everybody wants to buy it now because it's mac and cheese. If it was college, I mean, I know in college it was $3, $4 for mac and cheese. We get 3 mac and cheeses for $1, and that was the sale price when I was in college. And we would literally buy 10 3-packs. There were limits. I don't know if that's normal, but there were limits on how many you could buy. You could buy 10 because we would just put them all in the shopping cart. Like we're like, I guess we're eating mac and cheese this week because it's freaking 3 for $10. So we're gonna eat a lot. We're gonna eat a shitload of mac and cheese. Anything like that. When I buy steak, I'm not a big like price conscious shopper, but I'm looking at the steaks and there's one on sale and the other ones are not on sale. Unless I don't like the kind of steak it is, I'm probably going to buy the one that's on sale. I'm like, I guess we're eating sirloin this week, so I guess we'll have the New York steak this week. I was going to buy the ribeye, but it's the New York steak is half the price. I don't hate it. I'd rather have the ribeye, but I don't hate the New York steak. I know how to make a nice New York steak, so I'll take the New York steak. That's how you got to buy stocks. That's how you got to buy everything in life, right? The same thing for houses. People do this with houses all the time. My brother's a realtor, so I see this. I see this with his people. It's so crazy because they're spending $1 million on a house, right? but they'd rather buy the house that they had their mind set on. In other words, I want a modern 2-bedroom, this and that within 2 blocks of the beach, blah, 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 right? So they say all that shit and they want to buy that. But meanwhile, there's this really intensely nice Spanish sort of 3-story house that has 3 bedrooms, whatever, and it's less money than the one they wanted. It's more square foot than the one they wanted. It's 3 blocks from the beach instead of 2 blocks from the beach, but you can resell that one probably for more than you're buying it for if you wait 2 months. But they won't buy it, even though it's clearly a better value. Clearly a better value. That nice interiors, totally modern interior, just has a Spanish outside or whatever, stuff like that. But people just can't get out of their own heads. You got to recognize a value when you see a value, and you've got to understand I'm better off buying the value. And markets are not houses. You're not living in the goddamn stock. And you're not even living with the stock. You are investing in it, and you will sell it when it appreciates in value. But it ain't going to appreciate in value if you buy it based on the fact that you say, I like internet companies. And meanwhile, you're like, well, all the internet companies, which is exactly what I've been saying to people all year, right? All the internet companies were priced way too high. All the social media companies were ridiculous. The entire NASDAQ was ridiculous this year. And you know why we did so well this year? We didn't buy them. I refused to buy the NASDAQ companies this year. I did not invest in any of them except for Apple, basically. And we got out of Apple too, right? Because we said, well, that's it, it's done. But we never owned those things. We never went into the FANG stocks when they were flying higher and higher because I said, this is stupid. I don't not like tech stocks. I just didn't like the value. I like to buy things that are cheap. I like to buy things that have good value. That's our strategy. And you know what? It works. It works in bullish markets. It works in bearish markets. It works in flat markets. But you got to have the discipline. And that's what this is. That's what this watch list is. That's what selling short puts is when we're in the long-term portfolio. We always, not always, but we mostly start by selling a put. That's usually our first step towards building a position. And what did we just do? We just killed all of our puts. We had 40 puts, and we killed all but 3 of them, those 3 old ones. We killed all but 3 of the puts because I'm not positive what the first quarter is going to look like next year. Therefore, I don't know what I'm going to be excited to buy. Therefore, we killed the puts. We don't want to be forced to buy anything. And if I'm going to scramble with my money, I'm going to scramble by improving these positions that we decided to keep. I'd rather improve these than start messing around with new positions. But of course, once we sold the puts, then what happened? Then I said, oh my God, look at Apple. Apple was whatever price it was. I said, we're going to sell the 130 puts for $16.75 because we net in for $113.25. And I'm like, I definitely want to own Apple at $113.25, even though we already had these short guys, right? We sold the 105 puts more than a year ago. And those are only up 13%. You can still get $6 for the 105 puts and net into Apple for $99. That's a good deal. But we're comfortable with this price. We're comfortable with net 113 too. And so I'll take my $16,000 for promising to buy some Apple. Airbnb, Blackstone, GNRC, IMAX, Moderna, Rio, and Total Energy. Basically, these are all stocks we'd love to add to the portfolio as full positions, but right now they're just short puts. We keep an eye on them. And and see, well, who's the worst off? This guy, 5. Airbnb. So we said, well, we're willing to buy 500 shares of Airbnb at 90 minus. Oh, wow! Look at that big price too. 90 minus 19. So basically $70 for Airbnb. Where's Airbnb right now? 83. So the fact that we're down 28% only makes me say, is it time to buy my bull call spread now? And of course, like I said, I got to look at Airbnb. I got to see why they went down. Why did they go down so far since we went in? Is anything really wrong with them, or is it just an opportunity to get to make a full position? And obviously, I'm not going to do anything on that until I see their earnings because I want to understand what happened. Why are people bailing on them? But probably no good reason. All right, so see if anybody else has a question, and then I'm done because I'm losing my voice. And as I said, I'm tired. Well, I did pretty good actually, right? Almost went the whole 2 hours. All right. Thank you, Corey, for being my moderator today. You've been super duper helpful. The first guy to answer my questions properly. And thanks everybody else for coming. I appreciate it. And so we're going to finish up over the next few days. We'll be finishing up our watch list, and next week we'll talk about it some more. Okay, we'll get more into it, and have a happy New Year, everybody. Holy crap! I can't believe this year's over. Holy cow! 29, 30, 31. Okay, 3 more days. 3 more actual days of this year. But wow, went by real fast. All right, take care, guys. Thanks.